Hello and welcome to the RMI Advantage video training series. Today we will discuss accounting for inventory and cost of goods sold. Within Advantage, you have the ability to capture any inventory details, inventory levels, and also accounting for inventory. In today's video, we will take a look at an item card and the setups that are needed to have your inventory post to the correct accounts. We'll also navigate on a couple of posted vendor invoices. One of the invoices will be when we receive and then invoice, and the other invoice will be when we receive and invoice at once. And we'll also navigate on a posted sales invoice. And by navigating on both of these posted documents, we will see how the system accounts for our inventory. This video assumes that the viewer has basic knowledge of the item card and the posting setups within the system, along with how to generate and post a vendor invoice and a sales invoice. We'll get started today by taking a look at our item card. On our invoicing tab, we have two fields, the general product posting group and the inventory posting group, which we have highlighted here. I do want to mention that the codes in these fields are codes that we have set up internally. They're specific to our business, and the number in front of both of the codes is how we classify our different types of items. In this case, we consider our bracket a part, and in our inventory posting group would be where we set up our GL accounts for our balance sheet impact when this item is used on a transaction. When you drill into the inventory posting group field, you get the inventory posting setup. Here I've created a simple table that takes a look at our location codes, primarily the sales location codes, and also the inventory posting group for our parts. The combination of the location code and the inventory posting group on the item is where the system decides to post to our inventory GL accounts. In our example today, we're going to use the location of Hartford Sales, and we're going to use the inventory posting group of parts. In that combination, we'll have the system post our inventory transactions to the following inventory accounts. These are the GL accounts that we have specified in this posting setup, and although they are the same in both columns, we have the ability to select any general ledger account that we would want our inventory to post to. Let's take a moment to discuss the two columns, the inventory account and the inventory account interim. The inventory account column is where we specify the GL account that we'd like our inventory transactions to post to. And our inventory account interim works similar to an accrual account. When we post the receipt of the item, but we haven't posted our vendor invoice yet, the system posts an expected cost to the account that we have specified here in this inventory account interim. Then once we receive our vendor invoice and we go ahead and we post that, the system will then back it out of our interim account and put it into our inventory account. It'll make a little more sense when we take a look at our entries later on in this video. Back on our item card, the next field we're going to take a look at is the general product posting group. And again, the general product posting group is what drives our P&L impact. The code that we have specified in this field is just an internal code that we have set up for our company. When we drill in to this field, the general product posting group, we have the general posting setup show up. And the combination of the business posting group with the product posting group is where the system assigns its GL accounts. Here I've created a simple table that shows some of the accounts that we would want to hit, including our cost of goods sold account, our inventory adjustment account, our inventory accrual account interim, and our direct cost applied account. The code set up in our general business posting group is, again, just a code that we have set up internally to classify the vendors and the customers that we do work with. Now that we've taken a look at some of our setups, let's take a look at our first scenario. In our scenario, we've purchased a quantity of 10 brackets, and those are our parts. The cost, which we anticipate for each bracket, is $90. Our costing method is FIFO, first in, first out. And in this scenario, only the purchase receipt has been posted. We haven't posted our vendor invoice yet. After posting the receipt, you can navigate back to your posted receipt from the history area of your system. And when you navigate on that posted receipt, you receive this window here. These are the entries that the system makes behind the scenes based on the setups in your master records, your vendor card and your item card. In our example here, we're going to go ahead and we're going to drill into the GL entry. When you drill in, you receive this window. Let's analyze these transactions for a moment. When we posted our receipt, we're only posting what we expect these items will cost. Once that receipt is posted, the system then looks to our posting setups that we had taken a look at earlier to decide what GL accounts we should be posting to. If we take a look at our first account here, the 12830, if you recall from earlier, that's our inventory account, but it's in our inventory interim field, as you can see here. So when you post the receipt for our balance sheet impact, the system looks at our inventory posting setup, and it's looking at this inventory account interim. That was the debit in this entry, and the credit of this entry is here. It's our 2290 account. And if you recall from earlier, this is taking a look at our general posting setup. It's taking a look at that inventory accrual account interim that I have highlighted here. And if we take a look at our T accounts right now, this is how our transaction looks. We have our debit for the $900, that's the 10 brackets times the $90 that we think each bracket will cost, gives us the $900, and that's our debit in our interim inventory account. And the $900 credit is in our interim inventory accrual account. We've now received our vendor invoice, so we're going to go ahead and invoice for those brackets. In our scenario, we invoiced a quantity of 10 brackets, and again, they're parts, but our cost has changed. When we posted the receipt, we thought that the brackets were going to cost $90 each. But when we received the vendor invoice, they actually cost $105 each, so our cost has changed. Our costing method still stays the same, and in this scenario, again, we're posting the vendor invoice. Once you've posted the vendor invoice, you can go back in your history under purchases and take a look at the history there. Once you find the invoice, you can navigate on the invoice, and this is the screen that you would receive. In this screen, we have listed all of the entries or transactions that happen behind the scenes when posting the vendor invoice. We're going to take a look at the GL entries. When you drill into here, this is the screen that we'll get, and we'll take a moment to go over each of the entries. If you remember when we posted our receipt, we had hit our inventory interim account for $900. That was our debit. And our credit was to our accrual account. Well, in this first transaction here, once the actual vendor invoice has been posted, the system backed the $900 of expected cost out of those temporary accrual accounts that we had set up. If we take a look at our T accounts here, this is what we had when we posted the receipt. And then when we post the vendor invoice, the system goes ahead and posts a credit in our interim inventory account, and our interim inventory accrual account now has a debit. So when we take a look at this as a whole, it almost looks like nothing happened because all the entries net out to 0. The next GL entry that happened was for our $1,050, which was our $105 because our cost changed when we actually received our vendor invoice. If we take a look at our T accounts here, you'll notice that our inventory in-term account is no longer in-term. Now we're accounting for it in our inventory because we received our vendor invoice. The system posts a debit to our inventory account for the $1,050, and then it posts a credit to this purchase clearing account. And the last entry that happens when we posted the vendor invoice is we then back out the amount that we posted to our purchase clearing account, and we also hit our payables account for the amount of the vendor invoice. And when we take a look at our T accounts, this is what happens. Again, we hit our purchase clearing account for the debit, and then we hit our accounts payable for the credit. At this point, our purchase clearing account nets out to 0, and now we have a debit in our inventory, and we have our credit in our accounts payable. You may wonder why we're hitting the purchase clearing account at all. Based on setups within Advantage, we use this purchase clearing account sometimes as a reconciling account. When we do post in our scenario here, as you can tell, the system clears out the purchase clearing account itself, and it happens instantly. But the reason why we do have to hit that purchase clearing account at all is based on other setups in the system. And if we take a look at our value entries, we will go ahead and analyze the two entries that are here. If you notice in our first document type, we have our purchase receipt. So this was the value entry that was created when we had posted the receipt but had not posted the vendor invoice yet. In our first field, this cost amount expected, it's that $900 because we anticipated that it would cost us $90 for the 10 brackets that we were getting. And this cost amount expected is what that inventory interim account is. It's what you expect or anticipate to pay. But because you haven't received the invoice yet, it's not set in stone. And here, in our cost amount actual, we have 0 because for right now, when we post the purchase receipt and not the vendor invoice, we're just anticipating what we should get. So we don't know the actual amount that we should be paying. And our item ledger entry is 10. And what this signifies is that we are accounting for it in our inventory. Our quantity on hand has increased based off of the purchase receipt. And in our invoice quantity, we have 0 because again, we haven't posted our vendor invoice. We've only posted the receipt of those items. The cost amount per unit is $90 because that's what we anticipated paying when we posted our purchase receipt. Once you receive the vendor invoice and you post that, then the system created a purchase invoice line. In this first field, you'll see that our cost amount expected is a negative $900. This is where the system is backing the amount out of that accrual account for inventory and placing it into our inventory account because we're now recognizing it because we know exactly what we're going to be paying for these items. This would happen even if the amount was the same. So if we did end up staying with $90 per unit, the system would still back the amount out of our cost amount expected account. In the next field, our cost amount actual is populated because we now received our vendor invoice and accounted for it. So the system knows exactly what we're going to be paying. Our cost amount posted to the GL has now been updated by the system because once we posted that vendor invoice, the system went ahead and filled in our cost amount that was posted to the GL. Our item ledger entry quantity is 0 because we account for the inventory on the receipt. The invoice quantity is 10 because in this case we are being invoiced for the 10 from our vendor. And our cost per unit has changed. In our invoice, we definitely know that we're being charged $105, whereas in our purchase receipt, we thought we were being charged $90. Now that we've taken a look at the entries that the system creates when we do post a receipt and an invoice in a two-step process, we're going to take a look at how the system handles a purchase invoice and receipt in a one-step process by receiving and invoicing at once from the purchase order. To get to the GL entries that we're looking at here, we had navigated on our posted invoice, and it pulled up all the entries that the system had created behind the scenes, and we drilled in to our general ledger entries. Now, if you recall from earlier when we had taken the two-step approach of receiving and then invoicing, the system had created 6 GL entries. When you receive an invoice in one step, the system created 4 entries. And if you'll notice, they're for the exact cost amount that we received of the $105. Let's take a look at the T accounts to better explain what happened. In our two-step approach, these are the entries. We hit our interim accounts for the $900 that we anticipated being invoiced for. And then once we received our vendor invoice, we posted for a correct amount. And once we posted, the system backed the entries out of the interim accounts and hit our respective inventory and accounts payable account. Well, when you receive an invoice in one step, the system does not have to deal with those interim accounts because there's nothing to anticipate. You know exactly how much you're being charged because you have your vendor invoice. That clears out these $900 entries. And that's why when you receive an invoice in one step, you only have 4 GL entries as opposed to 6. The system will still hit our inventory account for the debit and credit our purchase clearing account, and it will also debit our purchase clearing account and credit our accounts payable. When we take a look at the value entries for receiving and invoicing in one step, you'll see that we only have one entry, and it's a purchase invoice. Our cost amount expected is 0 because, again, there's nothing to anticipate, so we're not hitting those interim accounts. The cost amount actual is populated because this is the actual amount that our vendor is invoicing us for. The cost amount posted to the GL, again, is the exact cost that we're going to be charged, and that's what hit our general ledger. And in our quantity fields here, they're all populated because the item ledger entry quantity was populated when we posted the receipt, and the invoice quantity was populated when we posted the invoice. And because we did them both in one step, it gives us one entry with those values populated. Now that we've taken a look at the vendor invoicing side and what would happen when we receive an invoice separately as opposed to receive an invoice in one step, we're going to take a look at the sales side. And in our scenario, what we're going to do is we're going to sell a quantity of the 2 brackets. Again, they are the parts that we have. And what we sell them for is $155 each. Our costing method will always remain the same. It's the FIFO method. When you ship an invoice, you have the ability to go ahead and take a look at the history and take a look at the posted invoice. When you navigate on it, you can get to all of the entries behind the scenes that the system makes. And when you drill into the GL ledger entries, this is the screen that you'll see. It's all the GL entries that are posted behind the scenes. The entry that I want to take a look at is the first 2 here that we have highlighted, the 12830 account and the 50510 account for $210. This is where the system is accounting for the cost of our inventory. It's taking the cost of the 2 brackets out from our inventory. When we take a look at the value entries that were created from that sale, we'll see first that our item ledger entry type is sale. Before, for the purchasing, it was purchase. And in this entry, we have a value populated in our sales amount actual field for the cost of the two brackets and the price that we charge for them. Our cost amount expected is 0 because there was no anticipated cost in this transaction. What we do have is the cost amount actual. Because we have that quantity on hand, the system knows what we paid for these two brackets or these two items that we sold, and it populates the cost amount field with that value. Our cost that was posted to the GL was for the cost, again, of the two items and what they cost us when we purchased them. Now, these amounts are negative because we're backing that cost out of those accounts because we no longer carry that cost. And in our quantity fields here, you'll see that we have -2 populated because we're accounting for the two that we sold. So what the system is doing is it's chipping away at our quantity on hand. And lastly, if we take a look at our item ledger entries for all of the scenarios that we had today, we'll see that we have two document types with purchase receipt and one with sales shipment. The two purchase receipts represent the invoicing that we did earlier. The first line was when we went ahead and we had taken a look at receiving and then invoicing in a two-step approach. The second purchase receipt takes a look at when we had received and invoiced in the one-step approach. And the sales shipment is the scenario that we had just taken a look at. The field that I'd really like to call your attention to is the remaining quantity field. Based on our costing method of first in, first out, the system behind the scenes has applied the sales that we just made to the first receipt or the first quantity that we had in. Although we did invoice for the quantity of 10, from that first batch that we got in, that first purchase receipt, we only have 8 remaining because those are the first 2 that we give to our customer, again, based on the costing method. To sum up what we've done today, we've taken a look at our item card and at the posting setups that drive the accounting behind the scenes. We had then navigated on 2 purchase invoices, one with the two-step approach of receiving and invoicing, and another with the one-step approach. And then we had taken a look at a sale that we had posted within the system and how we account for that sale in our entries. This concludes the video on accounting for inventory and cost of goods sold. Please be sure to watch all the videos in the Advantage video training series to make your job easier. Thank you and have a great day.